Welcome to Mauuak Saving Tips. I dive into JP Morgan's recession warning and see if I can navigate the storm without sinking my investment portfolio. JP Morgan's recent warning has sent shockwaves through the financial world, leaving many investors wondering what this means for their portfolios. The idea of a recession can be daunting, and it's natural to feel a sense of uncertainty about what the future holds. Many of us have worked hard to build our investment portfolios, and the thought of a recession wiping out our gains is a frightening one. The concerns surrounding JP Morgan's warning are very real, and it's essential to understand the potential implications for investors. A recession can have a profound impact on the market, leading to decreased investor confidence and reduced economic activity. This, in turn, can lead to a decline in stock prices, making it a challenging time for investors to grow their portfolios. The warning has sparked a lot of debate. Some experts predicting a mild downturn and others forecasting a more severe recession. Investor confidence is a crucial factor in determining market stability, and a recession warning can erode this confidence quickly. When investors lose faith in the market, they're more likely to sell their stocks, leading to a sharp decline in prices. This can create a self-reinforcing cycle, where falling prices lead to even more selling, and so on. The consequences of a recession can be far-reaching, affecting not just investors, but also businesses and the broader economy. A recession warning from a major bank like JP Morgan is not something to be taken lightly, and it's essential to consider the potential risks and consequences. The warning has sparked a lot of discussion about the current state of the economy and the potential for a downturn. Many experts are weighing in, sharing their thoughts on what this means for investors and the market as a whole. Some are predicting a minor correction, while others are warning of a more significant decline. The warning has also led to a surge in interest in safe haven assets, such as bonds and gold, as investors seek to protect their portfolios from the potential downturn. This shift in investor behavior can have a significant impact on the market, leading to increased volatility and unpredictability. The warning has also raised questions about the effectiveness of current economic policies and the ability of governments to respond to a recession. The concerns surrounding JP Morgan's warning are complex and multifaceted, and it's essential to consider all the factors at play. The warning has highlighted the need for investors to be proactive and adaptable. With a clear understanding of the risks and opportunities in the market, by taking a careful and informed approach, investors can position themselves for success, even in the face of a recession. The potential impact of a recession on investment portfolios is a major concern, and it's essential to understand the factors that could affect the market. Economic indicators, such as GDP growth and inflation rates, can provide valuable insights into the health of the economy and the potential for a downturn. Market trends, such as changes in consumer spending and business investment, can also offer clues about what's to come. Historical precedents can also provide valuable lessons for investors, offering a glimpse into how the market has responded to similar warnings in the past. By studying these precedents, investors can gain a deeper understanding of the potential risks and opportunities in the market. The warning has also highlighted the importance of diversification as investors seek to protect their portfolios from the potential downturn. Diversification can involve spreading investments across different asset classes, such as stocks, bonds, and real estate, to reduce exposure to any one particular market. It can also involve investing in different geographic regions, such as the US, Europe, and Asia, to take advantage of growth opportunities in different parts of the world. By diversifying their portfolios, investors can reduce their risk and increase their potential for long-term success. The key to navigating a recession is to be prepared and to have a clear understanding of the market and the economy. This involves staying up to date with the latest news and developments, as well as being mindful of the potential risks and opportunities in the market. It's also essential to have a long-term perspective, recognizing that recessions are a natural part of the economic cycle and that the market will eventually recover. To protect their portfolios, investors should focus on building a solid foundation of high-quality assets, such as dividend-paying stocks and government bonds. These assets can provide a steady stream of income and help to reduce volatility in the portfolio. Investors should also be careful to avoid taking on too much debt, as this can increase their risk and make them more vulnerable to a downturn. The main insight for investors is to be proactive and to take a disciplined approach to managing their portfolios. This involves setting clear goals and objectives, as well as being mindful of the potential risks and opportunities in the market. By taking a careful and informed approach, investors can position themselves for success, even in the face of a recession. In summary, JP Morgan's recession warning has significant implications for investors, and it's essential to understand the potential risks and consequences. The warning has highlighted the need for investors to be proactive and adaptable, with a clear understanding of the market and the economy. By taking a careful and informed approach, investors can position themselves for success and protect their portfolios from the potential downturn. The key is to be prepared to stay up to date with the latest news and developments, and to have a long-term perspective. The importance of understanding market signals and being proactive in investment decisions cannot be overstated. By staying informed and taking a disciplined approach, investors can navigate even the most challenging market conditions and achieve their long-term goals. The warning has also highlighted the need for investors to be flexible and to be willing to adjust their strategies as market conditions change. In conclusion, JP Morgan's recession warning is a significant development that requires careful consideration and attention from investors. The warning has highlighted the need for investors to be proactive, adaptable, and informed, with a clear understanding of the market and the economy. By taking a careful and informed approach, investors can position themselves for success and protect their portfolios from the potential downturn. Let me know what you think about JP Morgan's warning in the comments below, and do want to forget to check out my other videos for more insights and analysis on the latest market trends and investment strategies.